The price of gold has recently been a hot topic, capturing the attention of investors and economists worldwide as it climbs to unprecedented heights. This surge isn't just a fleeting market fluctuation. It represents a complex interplay of global economic forces, investor sentiment, and historical precedent. For centuries, gold has been regarded as a bastion of stability in turbulent times, a tangible asset that retains its value when traditional currencies and equities falter. Its recent performance, breaking through previous records, has reaffirmed this status. But what exactly is propelling this precious metal to its peak? Understanding the drivers behind this phenomenon requires a closer look at the intricate web of factors influencing its price. From macroeconomic policies set by central banks to the deep-seated psychological drivers of fear and uncertainty that guide investment decisions, the story of gold's current rally is a compelling narrative about the global economy's health, future expectations, and the timeless human quest for security. The recent surge in gold prices to an all-time high can be attributed to a confluence of powerful economic and geopolitical factors, each contributing to its appeal as a safe haven asset. At the forefront of this trend is the persistent and widespread global inflation that has eroded the purchasing power of fiat currencies. When the value of money declines, investors naturally seek assets that can preserve their wealth, and gold, with its limited supply and historical role as a store of value, becomes an obvious choice. Major economies around the world have been grappling with inflation rates not seen in decades, pushing both institutional and retail investors towards the perceived safety of bullion. It's a global phenomenon, indicating a collective loss of faith in the ability of central banks to swiftly bring inflation under control without triggering severe economic downturns. This environment of economic uncertainty is a fertile ground for gold to thrive, as it is seen as a reliable hedge against both inflation and the currency debasement that often follows aggressive monetary easing. Furthermore, geopolitical instability has played a crucial role in burnishing gold's luster. Ongoing conflicts, such as the war in Ukraine and the tensions in the Middle East, have created a significant risk premium in financial markets. These events introduce a level of unpredictability that rattles investor confidence, leading to a flight to safety. Unlike stocks or bonds, which are tied to the performance of specific companies or governments, gold's value is more insulated from regional political turmoil. It acts as a form of financial insurance against catastrophic events. When the world feels more dangerous and unpredictable, the demand for this ultimate form of security naturally increases. The actions of central banks themselves are also a major driver. Over the past couple of years, central banks, particularly from emerging economies, have been accumulating gold reserves at a record pace. This strategic buying is part of a broader de-dollarization trend, where countries are seeking to reduce their dependence on the US dollar and diversify their foreign exchange reserves. By holding more gold, these nations aim to enhance their financial sovereignty and shield their economies from the effects of US monetary policy and potential sanctions. This sustained, large-scale purchasing by some of the biggest financial players in the world provides a strong and stable floor for gold prices, adding significant upward momentum. The journey of gold to its current peak has been a gradual, multi-stage process built upon the foundations laid by major economic events over the past 2 decades. The first significant catalyst was the 2008 global financial crisis. The collapse of Lehman Brothers and the subsequent systemic risk that spread through the global banking system shattered the illusion of a perpetually stable financial world. In response, central banks, led by the US Federal Reserve, unleashed unprecedented levels of quantitative easing QE, injecting trillions of dollars into the financial system to prevent a total collapse. While this action stabilized the markets, it also sowed the seeds for future inflation and currency devaluation. For many investors, this was a stark reminder of the inherent risks of a fiat currency system. The crisis firmly re-established gold in the minds of a new generation of investors, not just as a commodity, but as a critical monetary asset and a hedge against systemic failure. Following the crisis, gold embarked on a multi-year bull run, setting a new nominal high in 2011 as sovereign debt crises, particularly in Europe, kept this sense of perpetual uncertainty alive. The next major phase of gold's ascent was triggered by the COVID-19 pandemic in 2020. The global lockdowns and the abrupt halt of economic activity prompted an even larger and more globally coordinated wave of monetary and fiscal stimulus than seen in 2008. Government and central banks across the globe pumped massive amounts of liquidity into their economies to support businesses and households. This deluge of new money, combined with supply chain disruptions, laid the groundwork for the inflationary pressures we are experiencing today. As the pandemic unfolded, gold prices surged, breaking the 2011 record as investors once again fled to its safety amidst profound uncertainty about public health and the economic future. This period demonstrated gold's role as a crisis hedge, performing precisely as expected when fear and uncertainty reached their zenith. Following the initial pandemic shock, the narrative shifted from immediate crisis response to the long-term consequences of the stimulus. As inflation began to accelerate in 2021 and 2022, central banks were forced to reverse course and embark on one of the most aggressive interest rate hiking cycles in history. Initially, this rise in real interest rates created headwinds for gold, as non-yielding bullion becomes less attractive compared to interest-bearing assets like bonds. However, this effect was temporary. The market's focus soon shifted to the potential fallout from such aggressive tightening, namely, the risk of a recession and the inevitable pivot back towards lower interest rates that would follow. Toward the future, the outlook for gold appears to be supported by several enduring trends, suggesting that its recent peak may not be a final summit, but rather a new, higher plateau. A key factor shaping this future is the evolving stance of the U.S. Federal Reserve and other major central banks regarding interest rates. The consensus is that the aggressive rate hiking cycle initiated to combat post-pandemic inflation is at or very near its end. The market is now pricing in a series of interest rate cuts, with the primary question being not if, but when and how quickly they will occur. A pivot to a more dovish monetary policy is fundamentally bullish for gold. Lower interest rates decrease the opportunity cost of holding non-yielding gold, making it a more attractive investment relative to bonds and savings accounts. As central banks begin to cut rates to stimulate slowing economies or respond to financial instability, the appeal of gold as a store of value is set to increase significantly. This anticipation of future rate cuts is already being factored into the current price, but the actual implementation of these cuts could provide further impetus for the metal to explore even higher price levels. Beyond the immediate actions of central banks, the long-term structural changes in the global economy also favor gold. The aforementioned trend of de-dollarization by central banks in emerging markets is not a short-term trade, but a strategic, multi-decade shift. Countries like China, Russia, India, and Turkey are likely to continue diversifying their reserves away from the US dollar to mitigate geopolitical risks and increase their own financial autonomy. This persistent, price-insensitive demand from some of the world's largest financial institutions provides a strong, underlying bid for gold that is likely to continue for the foreseeable future. Furthermore, the immense and growing levels of global debt, particularly sovereign debt in major Western economies, pose a long-term risk to financial stability. The U.S. national debt, for example, is on an unsustainable trajectory. Historically, high levels of government debt are often resolved through some form of currency debasement or financial repression, where inflation is allowed to run higher than interest rates to erode the real value of the debt. In such a scenario, gold stands out as one of the few reliable assets that can protect wealth from this slow but certain erosion. Investors, both large and small, are increasingly aware of this long-term fiscal imbalance, and many are positioning themselves in gold as a long-term insurance policy. The prospect of a Federal Reserve interest rate cut is perhaps the single most significant catalyst on the horizon for the gold market. The entire financial world hangs on the words of the Fed, and its monetary policy decisions have a profound impact on asset prices globally. When the Federal Reserve raises interest rates, it generally creates a challenging environment for gold. Higher rates increase the yield on U.S. Treasury bonds, which are considered one of the safest investments in the world. This makes holding gold, which pays no interest or dividend, relatively less attractive, as investors can earn a risk-free return elsewhere. This concept is known as opportunity cost. However, the market is forward-looking. The current high price of gold suggests that investors are looking past the current high-rate environment and are instead focusing on the inevitable future pivot. The market widely anticipates that the Fed will have to start cutting rates in the near future, either because inflation has been sufficiently tamed or, more critically, to prevent or mitigate a significant economic downturn. Once the Federal Reserve begins to signal clearly that rate cuts are imminent, and then actually starts to lower the federal funds rate, a new dynamic will take hold. A lower interest rate environment will directly reduce the yield on government bonds, thereby lowering the opportunity cost of holding gold and increasing its relative appeal. Moreover, rate cuts are often accompanied by a weakening of the US dollar, as lower rates make the currency less attractive to foreign investors seeking yield. Since gold is priced in US dollars globally, a weaker dollar means it takes more dollars to buy an ounce of gold, thus pushing its price higher in dollar terms. This inverse relationship between the dollar and gold is a well-established market dynamic. Therefore, a Fed pivot is expected to act as a powerful, dual-engine tailwind for gold prices. The anticipation of this pivot is what has helped fuel the recent rally, and the actualization of rate cuts is what many analysts believe will sustain it and potentially drive prices to new, even more remarkable highs in the coming months and years. Ultimately, the narrative surrounding gold's recent performance and its future prospects is a reflection of broader anxieties about the state of the global financial system. The combination of persistent inflation, escalating geopolitical tensions, unsustainable government debt, and the anticipated end of the monetary tightening cycle has created a perfect storm for the precious metal. It has reasserted its ancient role as the ultimate store of value and a safe harbor in times of uncertainty. While financial markets are notoriously difficult to predict, the underlying structural forces supporting gold appear robust and long-lasting. As investors navigate a world fraught with economic and political risks, the timeless allure of gold as a protector of wealth is likely to shine brighter than ever. For those seeking to understand the currents of the global economy, the price of gold remains an indispensable barometer, signaling the pressures and shifts happening deep within the foundations of our financial world.